Okay. So this morning we're going to look at taxation, which is lesson three. Uh, so it's taxation of individuals, which is employment income, investment income, as well as farming income. So we're going to specifically look at the taxation of individuals, which is employment income, investment income, as well as farming income. Okay. So we're going to start with employment income, right? So I'm going to begin with defining what emoluments are. So emoluments are all payments received by reason of being an employee. So when you are an employee, all the payments that you receive, the wages, the allowances, and all the benefits which relates to that particular service that you offer to the company, those are what we call emoluments. So the other thing that we need to understand is the difference between employment and self-employment. So in taxation, or rather in law, uh, you're going to come across this. I think this is employment law. Employment law, when you tackle employment law, you're going to come across these differences. So the difference between employment and self-employment are these. So one, the contract. The contract that employees have is a contract of service, right? While self-employed individuals are under a contract for service. A contract of service, this is where an employee is given all the benefits, uh, they're given all the necessary tools, they're given everything that's required for them to carry out their job. And the employer is also obligated to offer pension benefits to these employees. So the employees who are under the contract of service, they're basically under the leadership or they're under the control of the company. While those who are self-employed, they're under a contract for service, meaning they have got some form of control over how they do their work, how they carry out their work, and just the time in which they can carry out their work and from where they can be able to carry out the particular job. So a contract for service, which is self-employed, the employer doesn't have control over how the the employer or the employee rather does the job. So then two, performance employees need to carry out the work themselves, while self-employed may delegate. So performance employees, when you're employed by a company, you're told the job that you need to do given the job description. But for self-employed individuals, they're just contracted, and when they're contracted, if they don't want to carry out that job, they can delegate it to somebody else. Then three, payment. Employees are paid a fixed rate of salary, while self-employed are paid a percentage of the contract. So employees, it's known, you get employed, you get a job, you're given a fixed rate of salary that you need to be paid at the end of the month. But for self-employed individuals, you negotiate with the employer, how much am I going to pay you? Okay, this is the contract that I'm giving you. So out of that contract, I'm going to give you 10% of the earnings. Then you get into the contract, that self-employed individual starts executing the job. Then benefits. The benefits, employees are entitled to benefits such as pensions, while self-employed are not entitled to any benefits aside from the contract price. So again, employees are under the contract are under the control of the company, while self-employed individuals are not. So employers, according to the contract law, or rather the employment law, employers are supposed to give benefits to employees, but the self-employed individuals who are under a contract for service are not offered any such benefits. So there are other differences. You can just take a look at the book, but for now we can just cover the four, so at least if a question comes, you can be able to write something. So now we're going to look at what we call the basis of payment. So the basis of payment, what is this? The basis of payment is used to determine when a taxable person is liable for taxation. So when exactly is a person liable for taxation? This is what the basis of payment tries to attempt to explain for us. So the basis used to determine employment income is actual receipts basis. So actual receipts basis, that's the basis that is used to determine employment income. So now, for the emoluments that are received by an employee, they are deemed to have been received earlier of For an employee, it's one, when the payment is made. Then two, when the employee is entitled to the payment. So emoluments, or rather the all the benefits, or let me just say the gross pay uh, that an employee is given is deemed to be received earlier of when the payment is made or when the employee is entitled to the payment. So whichever comes earlier between these two, that's when the payment is deemed to be received. That's when that person is liable for taxation. The earlier of when the payment is made, and two, when the employee is entitled to that particular payment. But for directors, the earlier of one, when the payment is made, they receive the particular amount that they're supposed to be paid. Then two, when the director is entitled to the amount, they're entitled by way of contract to that particular amount that they need to receive. Then three, when the amount is determined or decided. So when the company decides the amount that they need to pay the director, that also is deemed to be a point when that particular individual is liable for taxation. Then when the amount is credited to the company's accounts, so when we credit the when we when we deduct that money from maybe the bank, from the bank account, we credit the bank account, then that person is deemed to have received that money and they are liable for taxation on that particular date. Then end of the accounting period. So when it's the end of the accounting period, we can also say that director is liable for taxation. So the earlier of whichever comes first amongst these four, when the payment is made, when the director is entitled to the amount, when the amount is determined or decided, when the amount is credited to the company's accounts, in the end of the accounting period. For an employee, it's when the payment is made or when the employee is entitled to that particular payment. Any questions so far?
No questions.
Okay. So now, when we're calculating tax, right, for employment income, it has got a similar effect as though we're calculating the tax for a sole proprietor, right? So we need to establish the net pay. But in most cases, you're given the net pay. If not, if you're not given the net pay, we establish the gross pay, right? So we've got the gross pay, then we deduct all these deductible expenses, or yeah, then you arrive at the net pay. So now when we have that net pay, we need to add back all the non-deductible tax expenses, right? All the non-deductible expenses, we need to add them back. Just the way we discussed when it comes to individuals who are running a business. This is also what we do. So all the incomes that have been received by way of employment, right? They need to be added back if they are not deductible for tax purposes, right? So if they are not deductible for tax purposes, they need to be uh, deducted. Sorry, that need to be added back to the net pay. So these are some of the incomes and expenses which are, are taxable, right? So we've got one, the salary, wages and bonuses are taxable in full unless the amount is equal to or falls below the exempt amount. So there's a certain exempt amount. When you look at the tax bands, there's a certain exempt amount of incomes which should not be taxed, right? So if a salary is equal to that amount or below that amount, tax is not charged to that income. But if it exceeds that particular exempt amount, then tax is charged. So two, allowances given to employee for amounts paid for business purposes are taxable where the employer reimburses the employee more than the employee spent. The excess is the amount taxed, right? So for instance, um, a company did not give you money for lunch, but you're entitled to receive a lunch allowance. Then you go to, say, Hungry Lion, you buy your Hungry Lion, you spend 100 kwacha, then you bring the receipts to the company, but the company reimburses you 150 kwacha. So the difference between those two amounts is taxable income. So that 50 kwacha, that allowance is added back to the net pay so that we can charge tax on it. Then benefits in kind. Any amounts paid to help the maintenance of residence of the employee is taxable. Then two, all allowances paid to the employee for purchase of uniforms for official duty are taxable, right? So you are a director, you've got a house which the company has given you, right? So that you should be staying in with your family by way of employment and contract, right? So now, if a company gives you allowances, right? The company gives you allowances in relation to maintenance of your house. That amount is taxable, right? Sometimes in the exam, they they the company pays on behalf of the employee. So from the salary, right? Then the expenses they are paid on behalf of the employee, and those also are supposed to be added back to the net pay. Then allowances paid to the employee for purchase of uniforms for official duty are taxable. So when an amount is paid to the employee, here's 10,000. Rather, okay, let me just say here's 200 kwacha. Go and buy uniforms that you should be using at the office. That amount that's paid to the employee is taxable for tax purposes. Then medical expenses. Medical expenses. Medical expenses incurred by the employer on behalf of the employee, their family, or households for medical treatment are not taxable, right? So if that amount uh, relating to healthcare, you know, hospital bills, hospital services, if it's paid on behalf of the company, or if it's paid by the company on behalf of the employee, that amount is not taxable, right? But if that amount is paid to the employee, that money is transferred to the employee's account, that amount is taxable for tax purposes, right? Then five, benefits received by the employee in respect to bereavement are not taxable. You've got a funeral, then the company gives you money. They give you maybe 5,000 to help with the arrangements of the funeral. That amount is not taxable. Then six, cash vouchers are documents or stamps which can be exchanged for a sum of money at a later date. They are taxable. So cash vouchers, these are just simple documents. Like you a document saying, okay, in later time in the future you can come and collect money in exchange for that voucher that you have. That cash voucher is taxable. Then where we have got a non-cash voucher, which is a document which can be exchanged for goods or services at a later date, that is taxable consistent with the value of those goods or services which are going to be received at a later date. Then eight, allowances paid to employees in relations to board, lodging, and meals are taxable. So all amounts that are paid, maybe say you're supposed to go to Copper Belt, you go and check the warehouse there. You're given money to board a bus, right? That amount is taxable. You're given money to go and sleep in a lodge. You go to say Protea Hotel. The company gives you money to go and spend the night there. That amount is taxable. Even meals, you're given money to go and buy meals, that amount is also taxable. So long as the company gives you money, the company pays and wires that particular money to your account in relation to boarding, lodging, and meals, these are all taxable incomes. The nine, amounts paid to the employee in relation to restricting activities of the employee are taxable emoluments. So sometimes an employee, maybe a director, can engage, maybe it's a consultancy company, right? Then the director also has a competing consultancy company as well, right? Then the company can say, That company that the director works for can say, no, stop carrying out your consultancy activities because you're competing with us and we're not having business. So for you to stop that, here's a sum of money. So that amount that's paid to the employee for restricting those activities which are conflicting with the objectives of the company, that amount is taxable. Then 10, tips and services tips and services received from the customer are taxable emoluments. You're working in a restaurant, the customer likes your service delivery, then they give you 100 kwacha. According to ZRA, that 100 kwacha received from the customer is taxable income. Then housing allowance, educational allowance, and utility allowance are taxable. So all the allowances that you receive in relation to your housing, education of your children, and all utility allowances are taxable. So it doesn't matter whether the company pays on behalf of you or you're the one who pays, as long as it's housing allowance, educational allowance, and all utility bills, they are taxable. So most of the times in the exams, what they do is they say the director has 4 children, for example, then each child pays a school fee of 1,000, then the company pays these school fees on behalf of the employee, right? So that amount, which is 4,000, 4 children by 1,000, that's 4,000. That amount is taxable income. It needs to be added back to the net pay. Any questions
No questions.
or additions?
No additions. I'm just following.
Okay. So now we also have allowable expenses, right? So all revenue expenditure incurred wholly for employment, they are deductible, they are allowable. You don't add them back to the net pay. So one, traveling expenses incurred during the course of duty are deducted. So for instance, where you're at the office, then you're supposed to maybe go and file in returns at ZRA. Then the company books a Yango on your behalf, or they pay you money to go and book a Yango. That amount is deductible, it's not chargeable, it's not assessed for tax purposes. Then two, costs incurred in traveling from home to work, provided the work commences from home. So if you're beginning work at home, you know, you begin the work at home, then the company sends money for transport. That amount is deductible. Why? Because you started the work from home. But any other amount relating to traveling expenses, which, excuse me, are not included here, they're all taxable. All right. So long as you're traveling from work, one point of work to another point of work, that's deductible. You're traveling from home to work, provided the work begins at home, that amount is not taxable. Then two, we've got capital allowances. So capital allowances are given to self-employed individuals if they use their own plant, implement, and machinery to complete the assigned work. So if a person who's under um, a contract for service uses their own equipment, the amount is offered as taxable, or rather, the capital allowances are offered on that particular item, plant, or machinery that's used. If employers provide the above items, no capital allowances are given. So if employers they provide the equipment that is used in that particular job for a person who's self-employed, that particular amount is not uh, given as capital allowances, right? So subscriptions to professional bodies are deductible for tax purposes. So for example, subscription to ZiCA, that's deductible. So other subscription are done as long as it's not relating to any professional bodies that are relating to employees, that's not deductible. So there are certain subscriptions. Maybe you are employed as an accountant, right? Then you're also a lawyer. There are those people who have got primary and secondary careers. So you are working as an accountant, but you're also a lawyer. So That subscription to ZiCA is deductible for tax purposes, right? But that amount that you pay a subscription to ZiCA is not relevant to your employment because you're not working as a lawyer, you're working as an accountant. So the amount that you pay to ZiCA subscription is irrelevant. You don't have to deduct it. But the one that you pay to ZiCA, which is consistent with your employment, your job, this one is deductible. Any questions so far?
No questions.
Okay, then pension funds. So employees' pension contributions and all payments made to other pension funds are not deductible. So when we go through the question, you'll be able to understand how this is done, right? So all the payments, all payments in relation to pension funds, they are not deductible for tax purposes. They are not deductible for tax purposes. So both employers and employees NAPSA contributions are calculated as 5% of employees' earnings, subjected to a ceiling. Like the employees' NAPSA contributions are subjected to a ceiling of 278,256 per annum. So this is just for knowledge sake, but yeah, we had to include it as well. So now the gross pay is the basic pay plus all allowances, bonuses, commissions, overtime pay, leave days, and severance pay, which is basically a compensation for loss of employment, right? So NAPSA contributions must be paid by the 10th day following the month when the employee ends the emoluments. So the key point here in relation to the exam is all pensions, whether you've paid to NAPSA or some other pension benefit or private pension fund, those amounts are not deductible. You don't deduct them from the amount or the amount of incomes that have been adjusted. You don't deduct them, right? Are we together?
Yes.
Okay, then we have contributions made to NEMA. So all employee contributions made to NEMA or any other health insurance scheme is not deductible against gross emoluments. So it's the same effect as NAPSA. All the contributions to the health insurance, even though they are essential to somebody's health or the employee's health, they are not deductible for tax purposes. So the contribution is 1% of the employee's monthly salary, both employee and employer's contributions, right? The employer's NEMA contributions are made on behalf of the employee, do not result in tax benefits. So here the focal point, the most important thing is all contributions to a health insurance, largely NEMA, they are not deductible for tax purposes. So when you are going through your question, you find that no, the employee paid such and such an amount in form of NEMA pay, that amount is not deductible for tax purposes. So now, what happens when somebody loses employment? So there are those times when employment is done. Maybe you're fired, or the contract ends, or maybe you're just redundant. The company is not making enough money, then you are laid off. So when you receive money, according to ZRA, there are certain amounts which are exempt for tax purposes, and which are the pension that you're supposed to receive from the particular employment, the refund of employees' pension contributions. So the contributions that you make to ZRA, they are not taxable. The withdrawal of employers' pension benefits. So all the pension benefits that the employer paid to ZRA, to NAPSA, sorry, they are not taxable. Then gratuity is not taxable. Redundancy pay is not taxable. Then severance pay or compensation for loss of office is not deductible. Salary in lieu of office or lieu of notice rather is not taxable. Reparation Repatriation allowance is not taxable. Then service benefits eligible for payment only at the end of employment, they are not deductible. So it's important, you need to know this, because in the exam you're brought, this can be brought, you're given different sets of
Oh,
incomes, right? Then you need to
yes.
recognize saying, okay, these are not taxable, so I don't have to deduct them, or I don't have to add them back to the gross emoluments. So pension, refund of employers' pension contribution, withdrawal of employers' pension contributions, gratuity, redundancy pay, severance pay, or compensation of office for compensation for loss of office, salary in lieu of notice, repatriation allowance, service benefits eligible for payment only at the end of the employment. So these are not taxable. These are exempt for tax purposes. But we also have incomes that are taxable for tax purposes. And these incomes that are taxable are just the monthly salary. So the monthly salary that's given, the accrued leave pay, then the accrued service benefits. So the leave pay, the service benefits, as well as the money, the monthly salary that's paid to the employee, these are taxable for tax purposes. But the rest, the rest, these are not. So when you see any of these in a question, you have to know these are not added back to the gross pay. But when you see monthly income, accrued leave pay, as well as accrued service benefits, these are added back to the net pay or gross pay, depending on the phrasing of the question. Any questions?
No questions.
Okay, so now, how do we calculate pay as you earn? So the first step is you need to calculate the gross pay. So you're given the gross pay. Step two, you deduct all the allowable expenses, then you get the net pay. But most of the times in the exams, you're just given the net pay, right? The net pay. Then that net pay, you need to start adding back all the non-deductible emoluments, right? So for you to arrive at the net pay, you deduct certain expenses, right? Or certain expenses. Obviously, you deduct certain expenses. Maybe, for instance, the company pays school fees for your children on your behalf. That's deducted from the gross pay, right? Uh, Things like maybe household utility bills, they pay for your bills in advance. uh, that's deducted from your gross pay to arrive at the net income, and all these other expenses, right? So you need to add back all the non-deductible expenses. Then those that are deductible, you don't really add them back. So all the non-deductible emoluments, they are added back. Then four, you need to deduct the exempt amount. So all those incomes, all those expenses which are exempt, for instance, the subscription to professional body, which is ZiCA, that amount is uh, deducted from the gross pay. So now, then you calculate the tax payable using the tax band. So this will just when you go through your question, this is it's very clear, it's very easy. When you go through your question, that's when you'll be able to comprehend it very well. But you have to calculate the tax bands. First you deduct the amount which is non-deductible. So that amount which says 0%. So maybe 50,000 times 50,000 0%. That's the amount that is non-deductible, or that's non-taxable. That's exempt for tax purposes. So that's 50,000. Then the rest, then you deduct that amount as taxation. Then you deduct the tax already paid. So if you already paid payee, that amount is supposed to be deducted. Any questions so far?
No questions.
Okay, so there's certain penalties and interests that are paid. So payee should be paid within 10 days after the month in which the emoluments are due to the employee. Penalties and interests for late payments. One, penalty of 5% on overdue tax per month or part thereof. Then two, interest on Bank of Zambia discount rate plus 2%. So when you pay late, you pay a 5% on the overdue tax per month or part thereof. Then the interest on the Bank of Zambia discount rate plus 2%. So these are supposed to be added. Then that's the total amount of penalties and interest that you're supposed to pay if you pay tax late. Then this is just for knowledge's sake. For fraud, 54%, willful default, 35%, and negligence 17.5% of the omitted income. But this is not really examined as much. But these penalties and interest, these are sometimes you can be questions to calculate. Sometimes you're just told to explain what's the impact of not paying uh, tax on time. Then you also have to explain when the tax is paid within 10 days after the month which the emoluments are due to the employee. Any questions?
No questions.
Okay, so now let's look at taxation of investment income. So we're looking at withholding tax now. So now, withholding tax is charged at source on investment income and other incomes like consultancy fee, right? So when you have invested in, say, government bonds, I remember I was attending, there's this, we just call it it's just a presentation, it's just a short presentation at Bank of Zambia. So Bank of Zambia offers this presentation where you're taught about government bonds and how to invest in government bonds, right? So, and they said, when you invest, let's say treasury bills, so treasury bills are invested on a discount. So that amount that is received after the redemption or the maturity of the treasury bill is subjected to tax, which is about 16%. So no, the tax is 15%, then 1% handling fee. So now that 15% is paid at source. You, as the person who's receiving that money, you receive the money net of that 15%, right? And that's what withholding tax is. So withholding tax is tax that is paid at source. You, the person who's receiving the investment income, you do not pay any tax, but the person that's giving you, that's issuing that particular uh, uh, investment income is the one that pays. So withholding tax is charged at source, which is the relevant uh, tax tax rate, right? So uh, the tax rate for the withholding tax is charged at source. The payer of the investment income collects the tax on behalf of ZRA, then that person remits that particular amount. So where withholding tax is the final tax, the income is not subjected to further taxation. So if the investment income or the tax on the withholding tax is the final tax, right? There's no other tax that's supposed to be charged apart from that withholding tax. That particular amount is not subjected to further tax. This is going to be relevant when you start going through questions. That's when you're going to really understand the importance of this. So withholding tax,
Okay.
which is the final tax, it's not subjected to further tax, right? Then withholding tax, which is not the final tax, is assessed further. So that amount, so where withholding tax is the final tax, I will emphasize the income is not subjected to further tax. So there are stages where, one, when you're calculating capital allowance, you need to add back those, or let me say, you need to deduct those with investment income, right? You need to deduct it from that tax adjusted amount, right? At gross. But if that amount that you receive as investment income is not is okay, let me begin with, it's a final tax, then you need to, you don't need to bring it to that section where you say deduct the amount of tax that's already been paid. You just forget about it. But if that tax is not the final tax, you need to bring it to that section where you say um, amount of tax already paid, then you deduct it from the you deduct it from deduct it from the tax that you have calculated. So with explained like this, it doesn't really make as much sense, but when you actually go through your questions, you're going to realize that it makes much more sense. And mostly for companies, when you're calculating tax for companies, this is where this section is very, very relevant. Are we together?
Yes.
Okay. So now withholding tax system. So these are the rates. So you need to make sure you know these. In the exam, you are usually asked this. So for dividends from companies not listed on the Lusaka Stock Exchange, is it the final tax? Yes. What's the rate? 15%. Dividends from companies listed on the Lusaka Stock Exchange. Is it the final tax? Yes. What's the rate? 0. So you need to know this because in the exam, you're not given these rates. You have to remember. You're just given, no, the company received dividends from a mining company. What is the withholding tax that's supposed to be charged there, right? So for mining companies, the final tax, it is, then the rate is 0%. For interest on government bonds, final tax, yes, then the rate is 15%. For individuals, this interest on government bonds, is it the final tax? Yes, right? Then it's what? 15%. And mostly when you're calculating a company um, taxation assessment for taxation, this is where they bring this a lot. But even in the individuals, they also bring it. But yeah, is it the final tax? Yes, then the rate is 15%. Then bank deposits, is it the final tax? Yes. What's the rate? 0%. Building society interest, is it the final tax? Yes. What's the rate? 0%. So you need to know these percentages. Then treasury bills, is it the final tax? Yes. What's the rate? 15%. Other types of interest, is it the final tax? Yes. What's the rate? 0%. Then royalties paid to non-resident, is it the final tax? No. What's the rate? 0%. Then royalties paid to residents, is it the final tax? No. Is it, what's the rate? 15%. Management and consultancy fees to non-residents, is it the final tax? No. What's the rate? 20%. Management and consultancy fees to residents, is it the final tax? No. Is it the rate? What's the rate? 15%. Then rent, yes. What's the rate? 10%. Winnings on bettings and lottery, is it the final tax? Yes. Then what's the rate? 20%. So you need to know these rates because they're very, very important when you're dealing with withholding tax. If you know these interest rates, if these tax rates, then a question comes on withholding tax. You can hammer, if it's 10, 10, 10 marks, you can hammer all the 10 marks just like that. Provided you know these rates and you know where to apply them and what's the impact. So if you know these rates, I'm telling you, when you just bring withholding tax, you just look at it saying withholding tax. You just be like, okay, but 10 marks of hammered. Any questions?
No question.
Okay. Now let's look at taxation for farming income. So taxation for farming income is like this. Oh, taxable profit is calculated in the same way as other business entities. So the way we calculate taxable amounts is the same thing with farming income. There's no difference. So deductible expenses, which are revenue in nature and incurred specifically for business purposes, are deductible. And capital expenditure and other non-deductible expenses are added back to the net profit to arrive at the taxable business profit. So just the way we did it last time, when you're calculating the taxable profit, it's the same. There's nothing that changes. It's the same, right? But the only difference for taxation for farming income, the tax rate is 10%, whether individual or a company. So for a farming concern, for a farming company, we do not apply tax bans, even though it's an individual. We only charge a 10% interest, or rather 10% tax rate. We do not use tax bans for farming income, right?
Yes.
But the tax rate is what? 10%. Are we together?
Yes.
Yes. So you calculate the amount of taxation or the amount of taxable income. After you calculate the amount of taxable income, and then you deduct, or sorry, rather you multiply or you charge 10%. So 10%, you do not use tax bands. So whether company or employee, the tax rate on farming income is 10%. When you go through a question, you're going to observe saying, okay, this is how we actually do it. Then capital allowances are also given on farming income. So, or implement plant machinery which is exclusively used for farming purposes, capital allowance is given at 100%. So tractors, plows, farming implements, irrigations, and harvesting equipment. So when a company buys or an individual buys a tractor, a plow, farming implements or irrigation and harvesting. Every implement, every planted implement which is used for farming purposes is 100%. The whole cost is given as capital allowance. If a tractor is purchased at 30,000 or not 500,000, for example, that amount is the capital allowance. If a plow is purchased for 10,000, that whole 10,000 is the capital allowance. Then, but we've got items like vehicles or commercial vehicles and non-commercial vehicles, which are used on the farm, maybe for delivery or just for other errands. Those you apply the same capital allowance principle, which is 25% or 20% where it's relevant. But items like tractors, plows, farming implements, irrigation and harvesting implements, these are charged at 100%. Then we also have farm works. So what are farm works? So farm works is a permanent works on the farm, right? And the capital allowance is 100%. Even farm works as well, the capital allowance is 100%. The whole cost is the capital allowance. So we've got expenditure on construction of barns and other storage buildings. So we are a farm. Then we've got a piggery. That piggery, the amount that we spend on building that piggery is deducted as capital allowance. The whole amount, if it's 20,000, is deducted as capital allowance. Then expenditure on construction of farm dwellings. So we are at the farm, then we've got a house at the farm. So we spend maybe 100,000 on that particular house so that we can be staying there. That amount is deductible as capital allowance, but not the whole amount. It's limited to 20,000. So if you spend 100,000, the only capital allowance for construction of a farm dwelling or a house that you stay in is 20,000. No matter how much you spend, the capital expenditure, or rather the capital allowance on that construction expenditure, is limited to only 20,000 of that particular cost. Then expenditure incurred on fencing. So we're putting a fence around the farm, maybe to prevent thieves from coming in and stealing our crops. That whole amount is charged as capital allowance, which is 100%. Then expenditure on construction of buildings for welfare of employees. We've got employees on the farm. Then these are working for us. The amount that we spend on constructing houses for them, that's charged as capital allowance, and the whole cost, which is 100%. Then note, if land is transferred from one farmer to another during the year for which capital allowance could have been claimed, the farm works allowance is apportioned. So if in the year we had some farm works, then the land is sold to another farmer, that capital allowance resulting from that maybe construction of a barn or construction of a piggery or construction of a fence is apportioned to each farmer, which if it's one farmer to another, then the capital allowance is split between. Then we also have what we call farm works. So farm works are all expenditures for work carried out on the farm other than farm improvements. So for example, we want to start farming, right? Like it's a bush. It's a bush, then we need to clear that land, So before we can start cultivating, we need to first clear the land. So the cost that we spend, or the amount that we spend on clearing that land, that's what we call farm works. So that farm works, the whole amount that we spend on clearing that land is deductible as capital allowance. If it's 50,000, that whole 50,000 is deductible as capital allowance. Then expenditure on works to improve soil erosion. So those works that we put in so that we prevent soil erosion, that's also charged at 100% of the cost. Then wells, we dig a well on the farm, that's capital allowance as well, at 100%, which is farm works. Then boreholes, stamping and clearing, which is just what I explained, clearing land before you cultivate. Then expenditure on water conservation, also these are farm works. Then these are charged at 100%. So you have to be very careful. You read the requirements very well so that you're able to understand and remember. So even when you're calculating the capital allowance, because both farm improvements and farm works, they are charged at 100%. So the examiner is going to give you marks based off you making a distinction. So if it's maybe an expenditure to build a piggery, I've used the piggery example so much. Okay, if it's an expenditure to build what do you call those? Where you keep chickens? What do you call those?
The chicken line.
Yes, if it's expenditure to build a chicken run, you have to tell them farm improvements, capital allowance, that particular cost times 100%. Then you write that amount. Then if it's an expenditure to build a well, to dig a well rather, farm works, capital allowance, chakuti, then you you include that particular amount as capital allowance. Any questions so far?
No question.
Okay, contributions.
No contributions.
Okay, so now we're going to look at the last part now, development expenditure. So development expenditure, this is basically expenditure that you spend, like, okay, you've got a land, maybe 3 hectares. You want to build, or rather, you want to cultivate a plantation. You want to put in place a tea plantation. So all the expenses that are incurred in putting that plantation together, maybe a banana plantation, a tea plantation, a coffee plantation, or oranges, citrus fruits, everything relating to just put in place a plantation. Those are development expenditure, and the capital allowance is 10%. So if you spend 100,000 and put in place a plantation for avocados, the capital allowance given is 10% of the expenditure. With that said, our lesson has come to an end. Any
Okay.
questions or contributions?
No questions, but I'm sure it will make sense when we do the calculations.
Yeah, yeah, I think it will.